Herald van der Linde, Head of Asia Equity Strategy at HSBC, is also now joining in. Herald, first, give your thoughts on what's happening with respect to the U.S. economy, its resilience. Parse what Fed Chair Powell had to say, plus the four big banks in terms of earnings and the commentary that we got from JP Morgan, Wells Fargo, Citi, and Goldman Sachs, and what it implies about the U.S. economy.
Yes, thanks first of all for having me on. And I wonder if you guys are already in Diwali mood, and with gold prices as they move. Actually, presumably all the Indian ladies are already in Diwali mood. But focus on the US first. The data that is coming out of the US is somewhat conflicting. So we see upward revisions on what we call hard data. So that's really kind of GDP data and these sort of things. And Powell was stressing this as well, that parts of it actually are doing a little bit better than anticipated. But if you look at soft data, which is surveys and these sort of things, they actually don't look so good. So you can actually spin almost two stories. One saying, well, actually, things are pretty good and you should ignore the soft data. Or you look at the soft data and say, yeah, the hard data is good, but, going forward, things are going to slow from here. And then it's going to kind of make it more difficult to see what the trajectory of interest rates is going to be. Consensus is that they're going to go down, but my suspicion is that they're not going to go down as quickly as what the market is currently anticipating. But that's really the sort of picture that emerges from the US. A bit confusing, to be frank. And you can take either side of the debate at the moment, and that creates that volatility in views and in the market.
All right. Hi, Harold. Good morning and good to see you. Ben, Nigel on this side. Well, I'm looking at the Asian markets and, funds are overweight Korea. Do you see some money flow out of that market, say, given the kind of overweight stance that they have, and maybe flow towards a market like India, which has been devoid of any kind of FII flows? Also, the other question is, China has done very, very well. Do you think India and China can party together, or is it a toss-up between the two?
Well, there's two questions here. So unpack them both separately. So first, Korea and India. I think you are right. I think what we're going to see is outflow from Korea into India. And I'll tell you why I think this is the case. AI is the key driver in North Asia for Taiwan, to a certain extent Japan and Korea as well. And I think the AI story is now very well understood. Everybody is invested in it. Most funds are heavily overweight, for example, on Taiwan, and heavily overweight all the stocks that are AI exposed. So I wonder if at some point in time we're going to get a sort of reset in the expectations. How that comes, when that comes, I don't know. But I think something like that is going to happen at some point in time. But okay, we've all priced it in, everybody's bought into it, but maybe it's slower than anticipated, the AI adoption. Maybe there's more political risk to it. We don't know. But people are bought into that story. The story that haven't really bought into it is India. And I think India is increasingly starting to look interesting. Now, that is because we've already seen lower valuations and earnings expectations come down and these sort of things. People have left India. They've moved their money exactly to Korea and Taiwan. So I think we're going to see a flow from North Asia into India gradually appearing over the course of the next couple of months. Now, your second question is related to this. Can India perform if China performs? And I think it can, because the reason for the performance of China at the moment is not because foreigners are coming in. It's because Chinese are buying it. The Chinese, if you are in a Chinese household, right? You live in China over the last couple of, say, 5 years. You had COVID, you had weak economy, you had a property market that was falling, you had a stock market that was really bad. What do? You hoard cash. That's exactly what Chinese have done. They put money in the bank. They don't really get anything out of it. If you put money in the Chinese bank, you get less than 1%, maybe 1% at best a year, not a lot. So what you now see is that confidence is coming back, and they're putting that in the property market, in gold and crypto, but also in stocks. So it's domestic buying that is driving the Chinese market. And they do that because they don't want to be in deposits. It's not that they say we don't want to be in India. No, they don't have that really exposure to India. So that is driving China higher. And at the same time, if you get that AI, Korea, Taiwan going into India, India can perform as well. So I think India and China can perform at the same time, say the next, say, 6 or 12 months or so.
You know, I'm just, for the benefit of our viewers, I'm reading Herald's note that he wrote towards the end of September. While Indian equities have underperformed emerging markets by 32 percentage points since mid-September 2024, the worst performance since 2001, we now find the Indian market attractive. In cricketing terms, we expect it to return to form. They think the earnings are near the bottom and set to improve. India now appears attractive on a regional basis, and we now move India to overweight from neutral. So tell us what you like in India, and how would you position yourself? What's the kind of upside that you see in India?
Yeah, we used a couple of cricket terms in a particular note. Actually, to be honest, I've only played cricket once in my life. I hardly together. So
But you used it appropriately.
So helped me with that to a certain extent. But I know it's incredibly popular in India. But, the thing with India is that if you look at the valuations of China versus India, for example, you can take the rest of the region as well. China is up 30% year to date. India is at best flat, depending on which index you look at. So what we now see is that India is starting to offer value versus a market such as, for example, China. It is not so expensive anymore. And since we've upgraded, actually, I anticipated to get some pushback, and people say, "Are you nuts? Are you going to go over India? All the stories in Korea and Taiwan." But actually, I've found some people say, "Yeah, you know, you might have that might be a good reason to look at India." But it's year end, AI is still running it, so I think people are a little bit worried that they don't want to be move too quickly. But it's something that people are looking at. So India looking cheaper, the earnings risk was worrying. So people are not complaining about valuations anymore. They're not complaining about the earnings either, because earnings expectations will come down from very high and lofty to probably close to where we should be. So that's good as well. Now you have fiscal authorities and your monetary authorities also working to support the equity markets. It's not their objective, but what they do is supportive to equities. There's more liquidity around. So on the margin, I think India's starting to look better.
Good to hear. You're sounding a little bit more optimistic from the last time we spoke, Harold. But we started off by briefly talking about gold. What's the house view on gold? I mean, surprise everyone. 50% in a single year, 1 year.
Yeah. No, I mean, it surprised me as well. I would have loved to buy gold 6 months ago. It's my wife is more in the gold business than I in a particular sense. But I know a lot of Indian ladies must be very happy with this because it's one of the key household assets that you have in India, right? So some people must be doing pretty good in this. But I think the story on gold fundamentally is not about retail buying. Actually, I think retail buying already shows signs of slowing. For example, in China, the Shanghai price for gold is below the global price for gold. So retail buying is not so strong. I don't know what it is in India. I know also from retailers, for example, in Indonesia, have told me that retail demand for gold is really slowing down. What is driving this higher is actually, I think, central banks. Central banks are trying to diversify their assets. They have a lot of exposure to the US dollar, but they want to basically put their money into other parts of the basket. Central banks move large amounts of money around. We're talking about billions to hundreds of billions of dollars, and if you put it all together, trillions even. So they can't just go and do something in all markets. And one of the places where they can go to is, for example, to other very large liquid currencies. Think about the yen or maybe a bit the euro. And gold, of course. But gold is a metal where supply is limited. There's not going to be more gold every year. Well, a little bit is money, but not that much. So it means that the prices rise up very quickly. So we think that gold prices will eventually settle above $4,000 an ounce.
Right.
1,155, going to be exact, if I'm not mistaken.
Yeah. No, absolutely. Thank you very much, Harold, for joining us. Good speaking with you. Good conversation. As always.